On May 12, semiconductor stocks had their worst day in months. Qualcomm dropped 12%, Intel fell 9%, the iShares Semiconductor ETF sank 5%. The AI trade, which had been running at full steam for most of 2026, looked like it was finally cracking. And on that exact same day, Wells Fargo analyst Aaron Rakers raised his Nvidia price target from $265 to $315. That's a 44% upside call issued on the same morning. The rest of the chip sector was bleeding out. With Nvidia reporting Q1 earnings on May 20, today we're going to work out which signal is telling the truth. My name is Phoebe, and you're watching Trading Key. Why chip stocks had their worst day in months. Let's start with why chips sold off, because the explanation matters more than the number. May 12 brought April's CPI reading, 3.8% year over year, above the 3.7% consensus. Core CPI came in at 0.4% month over month, the hottest single-month print since January 2025. The culprit was energy, which jumped 3.8% in a single month, driven largely by the ongoing US-Iran conflict, pushing oil above $100 a barrel. Hot inflation means the Fed stays on hold longer. CME FedWatch futures now price in 0 rate cuts for all of 2026. There's even a 30% chance of a hike by year-end. That is a regime shift from where consensus was sitting at the start of the year, and it matters for tech stocks specifically because long-duration assets get repriced hardest when the discount rate stops falling. But here's the thing. The macro story only explains part of the sell-off. The other part came from a KeyBank report showing PC laptop shipments fell 27% month over month in April. That's the kind of number that rattles investors in companies like Qualcomm and Intel, which still carry meaningful consumer PC exposure. For Nvidia, which has essentially completed its pivot to data center AI hardware, the PC demand story is largely irrelevant. Nvidia got dragged into a sector-wide sell-off that wasn't actually about Nvidia's business. That distinction is worth holding on to as we go through the rest of this. What Wells Fargo's $315 price target is actually built on. Wells Fargo's Aaron Rakers didn't raise his target because he was feeling generous. He built a new model. The core of it is gigawatt capacity. Nvidia's data center revenue is directly tied to how many gigawatts of AI compute capacity the hyperscalers are deploying. Rakers projects that installed capacity scales from 9.2 gigawatts in fiscal 2026 to 25.2 gigawatts by fiscal 2029. That's nearly 3 times the current base, built and paid for over 3 years. Under that projection, Nvidia's data center revenue reaches $354 billion in fiscal 2027 and $628 billion in fiscal 2029. These projections aren't detached from reality. Microsoft, Meta, Amazon, and Google have collectively committed over $650 billion in AI infrastructure spending in 2026 alone. That capital gets converted into hardware, and the dominant hardware vendor is Nvidia. Nvidia closed its fiscal year 2026 with $215.94 billion in total revenue, up 65% year over year, and data center accounted for $193.7 billion of that. The business that's projected to generate $628 billion by fiscal 2029 already generates nearly $200 billion today. The model isn't speculative. It's an extrapolation from a business that is already enormous and already growing fast. Then there's the valuation angle, which is one of the more counterintuitive things happening in chip stocks right now. Nvidia trades at roughly 23 times forward earnings. AMD, which has lower revenue, lower market share, and less earnings power, trades at 30 times forward earnings. The dominant player in the most important hardware category of the decade is actually cheaper on a valuation basis than its main competitor. The market is paying for AMD's growth potential while treating Nvidia like a mature compounder. Whether that's a mispricing worth acting on is exactly the kind of question May 20 will sharpen. The risk that's hiding inside Nvidia's own guidance. Now, the other side, because there are real risks here and they don't get enough airtime, Nvidia's Q1 revenue guidance is approximately $78 billion. That's the headline number analysts will be watching on May 20. But here's what's baked into that guidance that most people skip past. It explicitly excludes roughly $50 billion in China demand. Export control restrictions prevent Nvidia from selling its most advanced hardware into China. Jensen Huang has called that a $50 billion lost opportunity. The demand is there, the hardware works. Nvidia just can't legally sell it. What that means is Nvidia's stated guidance is structurally depressed relative to actual demand. It also means any change in export policy is a massive wildcard. If restrictions tighten further, that $50 billion stays off the table indefinitely. If a trade agreement opens the door, even partially, that figure represents a step change revenue opportunity that isn't in any current model or consensus estimate. The second risk is the architecture transition. Blackwell is what's generating revenue today. Vera Rubin is the next generation, and Nvidia claims it reduces AI inference costs by 90%. That sounds like a great selling point until you realize hyperscalers will be asking very specific questions about Rubin's production timeline on the May 20 call. If those timelines slip, even by one quarter, CapEx plans shift, and the gap between Blackwell and Rubin becomes visible in forward estimates. This is the specific thing to listen for on May 20, not just the headline revenue number. Third, and this one cuts against the seasonal optimism we'll get to in a minute. In the 5 trading days following Nvidia's last 12 earnings reports, the stock advanced only 5 times. Post-earnings history is not uniformly favorable. Why Nvidia's May reports are different from the rest? That 5 out of 12 number deserves a closer look before you use it to make a decision. It covers all earnings reports across every quarter of the year. Q1 reports, which are the May announcements, tell a different story. Every Q1 earnings report Nvidia has delivered has been followed by a stock gain. Every single one. The standout was May 2023, when Nvidia jumped 23% the day after reporting and essentially launched the AI trade as the public came to know it. The Q1 seasonality exists because May is when Nvidia reports the results of its January to April quarter, which tends to capture the strongest data center procurement cycle of the fiscal year. CME options are currently pricing a 7.15% move in either direction around the May 23 expiry. Nvidia's actual average single-day post-earnings move is 6.32%. The market is pricing in a slightly larger swing than history suggests, which is typical for a high-profile report where significant uncertainty exists around guidance language. For long-term investors who aren't trading around earnings, the implied volatility is mostly noise. For anyone weighing timing, the options market is telling you the risk window on May 20 is wider than a normal quarter. What actually matters is not the direction of the stock in the first 24 hours after reporting. It's the guidance language on 2 specific items, Rubin production timelines and any commentary on China-accessible hardware. Those 2 data points will determine whether $315 is a number to work toward or a number that needs to be revised. Here's what to watch when Nvidia reports on May 20. 3 things to focus on when the earnings call happens. First, Q2 revenue guidance. Analyst consensus is sitting around $80 to $82 billion. Anything below $78 billion is a miss, and the stock will sell off regardless of what Q1 actually prints. Anything above $84 billion puts the sell the news crowd in a difficult spot. The guidance number matters more than the reported quarter. Second, gross margin. Nvidia has been running margins above 70%, which is genuinely extraordinary for a hardware company. Any compression signals either pricing pressure or a product mix shift, and either one gets repriced immediately. Third, Rubin. If Jensen Huang provides a specific production ramp timeline on the call, that is a stock-moving data point on its own, independent of what the revenue number says. The transition from Blackwell to Rubin is the next multi-year upgrade cycle, and May 20 is the first earnings call where investors will be pressing hard for specific. The chip sell-off on May 12 was not a Nvidia-specific story. It was a macro repricing that pulled the sector lower when hot inflation data hit. Nvidia's data center business runs on multi-year CapEx commitments, not quarterly CPI prints. That doesn't mean the stock can't fall further before May 20. But it does mean the gap between the price the market set during the sell-off and the $315 target Wells Fargo issued on the same day is worth understanding before that earnings call. So where do you stand? Are you buying Nvidia before May 20, waiting for the print, or sitting this one out entirely? Tell me in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.